National Grid delivered 8% underlying earnings per share growth for the full year, in line with its own guidance and ahead of analyst expectations, and the stock fell 7.29%. That is the kind of result that forces a holder to re-examine what they thought they owned. The surface reading is simple. Rising capital expenditure and growing debt unnerved the market. Capex surged more than 20% to £11.6 billion in the year. Net debt climbed $2.8 billion to $44.2 billion. The dividend rose 3.8%, matching UK CPIH inflation, which is exactly what a regulated utility is supposed to do. And the stock still sold off. The provisional answer is not in the income statement. It sits in the timing gap between when the investment goes in and when the regulated return comes back out. National Grid is not being punished for poor results. It is being priced as a machine that consumes capital today and delivers returns across a 20-year horizon, in an environment where that horizon is no longer politically stable. Goldman Sachs has a buy target at 1450p. Jefferies downgraded to hold in March, calling the regulatory catalyst pipeline for the remainder of the year thin. Those are not the same assessment of the same company. They are two different reads on whether the return cycle is credible at current debt levels. National Grid is executing the Great Grid Upgrade, a multi-billion-pound program to carry more renewable electricity across England and Wales, including the Western Link 2 between Scotland and Wales, which alone can power around 2 million homes. That program is why Capex jumped 20%. It is also why net debt reached £44.2 billion. The regulatory model is designed for exactly this. Spend today, recover through allowed returns on a growing regulated asset base over the asset's life. The RAB grows as the investment goes in. The return on that RAB flows through earnings for decades. On this model, $11.6 billion of Capex this year is not a problem. It is the engine of future earnings. The complication is the denominator. Debt at $44.2 billion against a market capitalization that was already under pressure means the equity cushion is thinner than it was 2 years ago. FY 2027 EPS is guided to $1.21. Deutsche Bank raised its target to 1430p on those numbers, but Jefferies explicitly cited the regulatory pipeline as the counterargument. If the next round of allowed returns comes in below the cost of debt, the RAB story inverts. What the market sold on Thursday is not the 8% growth. It is the question of whether the next regulatory settlement validates the investment or clips it. That question has no answer in Thursday's numbers, only in the price that Ofgem sets on future returns. The consensus treats this as a normal regulatory risk embedded in every UK utility. That assumption misses what entered the pool this week. Andy Burnham won the Makerfield by-election on 19 June and arrived at Westminster to be sworn in as MP. He is widely expected to challenge Keir Starmer for the Labour leadership within weeks. His allies have published their policy framework. The Guardian named National Grid explicitly. Eventually, Burnham's allies want to bring energy transmission and supply companies, possibly including National Grid, into public control. The document his advisors released, The Productive State, argues for a 10-year program to take energy transmission back under state control, using a bonds for shares mechanism, where investors receive government bonds instead of a market exit. The compensation price, by design, would be set by a government with an interest in minimizing the public cost. This is not speculation. It is in a named policy document, linked to a figure now expected to be Prime Minister, published the week he entered Parliament. The market is not fully pricing this. National Grid trades as a regulated utility, with political risk treated as a tail scenario. The Burnham framework makes it a named target, not because nationalization is certain, but because the compensation framework debate has already begun, and that debate puts a ceiling on the equity upside that no regulatory settlement can remove. Goldman's 1450p target assumes the regulated return cycle plays out for current shareholders. It does not assume a government bond swap at a statutory price set before the RAB investment cycle completes. Those are two structurally different assets priced the same way right now. The sell-off on Thursday was about Capex and debt. The forward risk that the pool now surfaces is different. It is about who collects the return on that Capex. The counter case must be stated directly. Burnham is not prime minister yet. The nationalization timeline his allies described is explicitly described as a decade-long process. Thames Water and Southeast Water are the near-term targets, not an electricity transmission company with $44.2 billion of debt and a functioning regulatory model. And the BOE held rates at 3.75% on June 18, a rate hold that, in an ordinary utility cycle, supports National Grid's valuation by reducing the discount rate applied to long-dated regulated returns. Goldman and Deutsche Bank's buy cases are built on exactly this: rates on hold, RAB growing, dividend inflation-linked at 3.8%. The question is whether that case survives the political variable. It does not need Burnham to win. It needs the market to begin pricing the compensation framework risk as non-trivial. And Thursday's sell-off, which came on a strong earnings beat, may be the first evidence that it already is. For the holder, the monitoring variable is not the next off-gem determination. It is whether Burnham formally enters the labor leadership race, and whether any compensation framework language moves from a think tank document into a manifesto commitment. That is the trigger that reprices the tail risk from theoretical to observable. For the watcher, the entry case rests on the FY 2027 EPS guide of $1.21 holding and the BOE moving toward a cut. If the BOE signals a cut and Burnham's leadership bid stalls, National Grid at its post-earnings level is priced for a risk that may not materialize. The holding variable is not today's earnings. It is whether the political ceiling gets priced in before the regulatory return is delivered. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.